How are mortgage rates determined? And what can you do to ensure a low rate? Hello, this is John Werner with Mortgage and Credit Pro. In this video, I will share how mortgage rates work. Several factors affect how mortgage rates are determined. You can only control one aspect of your mortgage rate, your personal factors. Lenders look at your qualifying factors to determine your risk level. The better your qualifying factors, the better the interest rate you'll be able to get. Mortgage rates begin with the current market rates. So you may wonder how the market affects interest rates. Mortgage rates are affected by the overall economy. When the economic outlook is good, rates tend to increase, and rates fall when they're not so great. Mortgage rates are determined by many elements, including the inflation rate, the pace of the job creations, and whether the economy is growing or shrinking. When the economy is doing well, borrowers can afford more. The Federal Reserve doesn't set mortgage rates, but it does affect them indirectly. The Fed controls short-term interest rates by increasing or decreasing them based on the state of the economy. While the mortgage rates aren't directly tied to the Fed rates, when the Fed rate changes, the prime rate, mortgages usually follow suit shortly afterwards. The Federal Reserve controls short-term interest rates to control the money supply. When the Fed tightens the money supply, they raise the Fed rate. While this doesn't directly increase mortgage rates, eventually banks and lenders must follow suit to keep up with their costs to borrow money from the Fed. You certainly cannot control the economic factors of a mortgage rate, but you can most definitely control your factors. Let's dive into what you can do to get the best mortgage rate possible. Beginning with your credit score. The higher the credit score means you're less risk to the lender. A higher credit score shows that you pay your bills on time and you don't overextend yourself. When lenders look at your credit, they see you as a responsible borrower at a low risk of default. The lender gives a better interest rate because you're less of a risk. When you have a lower credit score, lenders often change to a higher interest rate because you're at a higher risk of default of the mortgage. The credit score you need depends on the loan program you are using. If you want a conventional loan, you'll need at least a 620 credit score. If you're looking at FHA, you need a score of at least a 560. Taking the steps to check and improve your credit will put you in a better position to get a lower rate from your lender. The next factor is your down payment. Lenders want to know that you are invested in the home through your down payment and that you aren't borrowing 100% of the funds. The more money you invest in the home, the less likely you are to default. If you put less than 20% down on a home, your mortgage rate will increase and you'll need to pay private mortgage insurance. Some mortgage insurance can be canceled after a specific time, and some of them are the life of the loan. Besides mortgage insurance, if you put less than 20% down on a home, you also pay higher interest rates. You're at a higher risk of default with a lower down payment, and lenders make up for the risk by charging a higher interest rate. The next thing that will affect your interest rate is your loan-to-value ratio. A loan-to-value ratio compares the amount of loan you would like to borrow against the appraised value of the property you want to buy. The less money you put down on the home, the higher your loan-to-value becomes, which is a higher risk to the lender. When you put little money into a home, you have less incentive to keep paying the mortgage when times get tough. Another factor lenders will look at when analyzing the risk is how you intend to occupy the home. Lenders care about whether your home is your primary residence, which means that's where you'll be living, or if the home will be a second home like a vacation property, and if the home is an investment property that you'll be renting to others. Interest rates are usually lower on primary residence because it's where you live. You're most likely to make your payment on time because you don't want to lose your home. If you have a second home or investment property and you have financial issues, you're most likely to default on the mortgage, putting the lender at high risk. And that is the reason they charge higher rates. The bottom line that both market and personal factors affect your mortgage rate. While you can't do anything about the market conditions, you can control your factors. Improving your credit score and saving a larger down payment are two of the best ways to improve your chances of securing the best mortgage rates. Be sure to take care of what you can control about mortgage rates by looking closely at your factors and making them as good as possible to ensure you get the best interest rates available when applying for a mortgage. Always work with a licensed mortgage professional and get your questions answered. Thank you for watching. This is John Werner with Mortgage and Credit Pro. If you're looking to buy, sell, or refinance, please reach out. You can call me at 503-550-8842 for Oregon and Washington, or for Arizona, 623-363-0724, or my email is john@mortgageandcreditpro.com. Thank you.